Today we're going to be looking at a case study, my own numbers, using the velocity of money, velocity banking, paycheck parking, whatever you want to call it, the infinite banking concept, becoming your own banker, high cash value life insurance, whole life insurance, whatever you want to call that. We're going to combine those two strategies with three incomes: my income, fiance's income, and my mom's income. And what we're doing is we're going to use a first position home equity line of credit to purchase a single family property, of which I am going to be using a high cash value life insurance policy, my own, borrowing against the cash value for the down payment and the closing costs to basically self-finance down payment and the closing costs from my life insurance policy, which would allow me to retain every single dollar that I basically put into the pay down of this property while maintaining liquidity all the way through in case life happens, investment opportunity presents itself, and many other benefits that will come along the way. And then when you combine the velocity of money, velocity banking, we're minimizing the cost of interest as much as we possibly can by bringing these two concepts. So first position home equity line of credit to purchase a property, right? Now the benefit of doing this, right? Not all first lien HELOCs are treated the same. The one that I've decided to go with is a bank called University Bank. They have a 4.99 intro rate for the first 6 months, and the interest rate is based off of the 6-month treasury bill, right? And then they add, I think, 3 or 4%. I have to verify that. But basically, I'm starting off at 4.99% interest for the first 6 months. To underwrite the product, it only costs $950 to $1,000. That's just to acquire the product. When you compare that to many mortgages, 30-year fixed mortgages out there with the origination fee, just the origination fee alone, I was looking at the averages. It could be anywhere from 0.5% to a percentage point. And according to my math, based on the purchase price that I would be getting this property for, would be anywhere from $2,650 to $5,300 just in origination fees. So what I tried to do was a apples to apples comparison, but it's actually impossible because out the gate, I'm already ahead with the first lien HELOC position, simply because I pay less money in closing costs, which means that gives me more capital to apply towards the principal balance of the mortgage itself. And on top of that, with this first position HELOC, as long as the credit limit is under $750,000, I don't need PMI insurance. I don't have to get mortgage insurance on the loan itself or on the line of credit itself. Whereas if I went with the traditional conventional 30-year fixed mortgage, which I got quoted at 8%, all right, it's 2023 is when I'm recording this video, so the interest rate that I got approved for was 8%. Origination fee probably around 0.5 to a percentage rate with that, and I would have to put 20% down, which then I lose that liquidity. 20% of the purchase price of what I'm looking at would be around $106,000, almost $110,000. So I would immediately lose that liquidity just for the sake of not having private mortgage insurance. So if I put 10% down, I would still need private mortgage insurance on that, and that, I was looking at some estimates. It'd be around maybe $220, $219 per month. So whatever that is in a year, was that like $2,400-ish, something like that. So we're talking more money in PMI, more money in origination fees, versus if I go with a first lien HELOC out the gate, I'm already ahead. Plus, I got that 4.99 intro rate. Yes, it's only for 6 months. That's a pretty big difference. That's going to give me a pretty big gain. So all of those factors that I just mentioned, I actually didn't even account for, except for the PMI. I put it in there if I'm comparing just making extra payments, but I didn't account for the additional closing costs of going with a traditional mortgage, right? And we're going to see what it would look like if I just made extra payments with all three incomes going into the property. If I would have went with that 10% down, I immediately lose that liquidity. I can't access that money again. Versus with a first position HELOC to purchase a property, I put 10% down, I immediately will have a line of credit for whatever that balance went down to. And then if I wanted to apply another 10% to say full 20% in on it, I would immediately have access to whatever else I dump in, right? So any extra payments I dump into the first position HELOC, I'm gonna have immediate access to that, right? So in order for this strategy to work, if I was to just do extra payments, I have it here that it'll take about 29 months, maybe 30 months or less to pay the property off in full according to just making extra payments. That assumes life doesn't happen, absolutely nothing goes wrong, and I consistently cash flow, what that is. So I just lay that out there just to give me like a measurement stick. Okay, here's what it is. But what I want you to look at is I'm actually not intending to actually pay this property off, quote unquote, early. I'm just looking to be extremely efficient with the funds and making sure that I retain liquidity. And I'm also solving for how do I recapture every single dollar that I pay in interest to the bank? How do I recapture that and retain liquidity? So let's dive into this strategy here. Let's take a look at the whiteboard. I'm going to give you all the numbers here on the left-hand side. Again, we're dealing with 3 income streams, right? So I'm showing one income at $19,901.49 with expenses at $5,662.74, and that is all expenses considered on the personal side, everything all included. Cash flow would be $14,238.75. Then the second income would be $5,221.54, expenses at $3,100, cash flow at $2,121.54. I also created buffers in each of these expenses. So I created like a $600 buffer here, a $500 buffer here, another couple $100 buffer here. So I created buffers, overestimations on cost of living. So everything that I'm illustrating with velocity banking is going to be super conservative, overestimated. I'm making it look worse than what it'll actually be, and I still come out ahead if I was to just make extra payments, right, via everything going on here. But again, my intent is not necessarily to try and pay this off the fastest. In fact, I can honestly tell you that if I was to just make extra payments, right, without anything else that I would be doing, I would pay off the home faster if I just made extra payments, be done in 30 months. During that time, absolutely nothing can go wrong because I'm dedicating 100% of cash flow to pay down of mortgage at that 8%. That's all I can do. So no investing, no savings, right? Like none of that. I have no liquidity. So absolutely nothing can go wrong with this scenario. With velocity banking, infinite banking, combining actually all 3, because technically I am making extra payments, just doing it differently. I'm doing it more efficiently, more effectively, in my opinion. And you get to choose whether this makes sense for you or not, right? So continuing on, right, we got the income, second income, this is the third one, $2,985, expenses, $1,985, cash flow $1,000. The debt, which would be the first position HELOC, starting at $477,000, 4.99 is the intro rate. The most amount of interest I can pay in the first year is $23,802.30. That's assumed that I pay nothing towards principal, right? So on a monthly basis, that's what it would look like, $1,983.52, and then that would change after 6 months. So after the intro rate, I way overestimated and said that I'll be at an 8.41% interest rate. That assumes interest rates continue to rise, right? So I'd be somewhere around 8.41%. I'm willing to take a bet, a gamble here that interest rates will eventually start to go down or stay stagnant. And then the other thing that I am more than happy to do, because I'm not married to any bank or any product, I'm more than happy to move this HELOC to another HELOC and get another intro rate. And I'm seeing rates right now at 1.99% for 12 months. So I do something like that, or anything below 8%, right? Because that's what I'm comparing it to. I'm going to stay ahead of the game, right? And I'm going to pay the least interest possible. Then, in addition to this first position HELOC with these 3 different incomes, all income going into the first lien HELOC, all expenses coming out of the first lien HELOC, we're going to be leveraging multiple credit cards. So out of all the expenses here, we've identified $6,763.75 worth of expenses that can be paid with a credit card with no fees. So I would be earning around, I underestimated this, 2% cashback rewards. I can do more, upwards of 3. So I underestimated it. Average about $135.27 per month. And if you did the math, that's about an extra $1,623.24 extra in your pocket. Get applied the principal pay down of the first lien HELOC, right? Which is what would happen, right? What would happen is I'm applying the cashback rewards to the statement balance of the credit cards, which means less money is coming out of the first lien HELOC, more of the income stays in. So what I did was I also underestimated this result. So I basically said, okay, 477,000 minus 6,763.75 on a roughly 20-25 day cycles, there will always be an extra from the income, $6,763.75. That's staying in the HELOC. It doesn't actually come out for only one day, right? And that's to pay the credit card statement balance in full. So essentially what's happening is I'm floating $6,763.75 at 0% for roughly 20 to 25 days on a monthly basis. What that looks like is roughly I'm saving about $1, almost $1 in interest per day that I didn't pay in the HELOC, and then I earn 2% on that money, which results of 135. So I totally underestimated and just rounded down and said, okay, $20 is what I'm gonna minus from the monthly interest costs on the first lien HELOC just by parking bills in the credit card, because that means when the income lands in the first lien HELOC, and by the way, this is all automated. So I can connect all 3 incomes to the first lien, and I can connect all bill pay out of the first lien. So it's literally all automated. I don't have to think about making an extra payment each and every month. I don't have to tally the numbers up. I just have to be disciplined with how we all spend money in this household. That's it. So velocity banking is fully automated. My velocity of money cycle, my wheel, fully automated, right? Pretty good. Those are the different enhancers that really reduce the borrowing cost. Then on top of that, I have balance transfers that I can do with a multitude of credit cards, and I can literally do this, like we call this credit card stacking, where you leverage a bunch of 0% credit cards. I got 3 different incomes, 3 different credit scores. We could rotate between 3 different peoples, right, to pay even less interest. So all I did, super conservative, I used me alone, leveraging $25,000 of credit in a credit card, doing a balance transfer at 0% for 12 months and a 0% fee. No fee, no cost whatsoever, 1% minimum payment, $250. Do that for 12 months. At the end, you'll owe $22,000. I can either roll that 22 back into the first lien, or I can roll that 22 into the next credit card, which is what I would do over and over and over again. Taking a look at what this would look like, understanding that all the incomes are paid bi-weekly, so there's 6 checks coming in per month, all at different times. More than likely always on a Friday. So what happens, starting balance at 477. If you tally up all the incomes, right, you're going to get 28,108.03. You tally up all the expenses, you're going to get 10,747.74. On if I went with a traditional mortgage, the cash flow would be different, but the same amount, roughly the same amount, is still going toward the pay down of the mortgage, right, itself. So over here, same number, same income, everything, the cash flow would actually be the actual extra payment would be $14,471.37 as opposed to the total cash flow over here, which is over 17,000-ish. Just add up these 3 numbers, right? Add those 3 numbers, 14,671.3. It's like 14,300 something. Over here, it's 14,471.37. The reason for that is, a traditional mortgage is going to have the principal and interest payment. So out the gate, the interest is $3,180 as opposed to my minimum, or I should say my maximum interest cost of $1,983.52. You'll notice over here within the first month, I overestimated. It'll be less than this, but it'll be somewhere around $1,874.09. So out the gate, you can see the difference, $1,874.09, $3,180. Then you got PMI. So PMI is taking from the cash flow. So that's the only variable that I put in there is $219 less in cash flow, making extra payments. Because over here, I don't have PMI. It's the only thing I factored in here. I didn't factor in the origination fee cost to get that 8% mortgage, which would have cost me multiple thousands of dollars more. So that puts me at a technically the amount of cash flow out the gate starting would be a couple $1,000s less because it would have had to go to closing costs, right? So I show the expense right over here. Cash flow, $14,471.37. What I'm gonna go ahead and do is share my screen so you can see the mortgage calculator of how I went ahead and put all the numbers in so you can see what this actually produces. So 477,000, starting out, finance amount 8%, 30 years. Payment would be $3,506. That's just principal and interest. The actual mortgage payment would be the $3,506, the PMI, the taxes, the homeowner's insurance, right? All of that together. So the actual payment's a little bit higher, which is why you see the cash flow at the $14,471.37. I actually already factored it into the expenses on the board, which is why I didn't show a lesser cash flow, because I already factored it in as if it was already there. So extra payments out the gate, $14,471.37. And then what I went ahead and did was, okay, once you get to 20% paid on the property, which is right around the third or fourth, I don't know how long it takes to remove PMI. Go ahead and comment if you know roughly how long it takes to remove PMI off of your mortgage once you have paid into it that 20% mark to remove it, right? Let me know if you know that. What I went ahead and did is just gave it 30 days, right? And then you'll notice the cash extra payment is increased by that amount, plus 219. And you can obviously see it takes us 29 months and it's done. A lot of commitment. This assumes that I would cash flow this amount each and every month for the next 29 months, and life doesn't happen. Nothing happens. Nothing bad happens, like nothing. The reality is that what I've seen personally with a lot of clients is they, start with making extra payments. Okay, great. You're on a roll, and then life happens. Kid gets sick, spouse gets sick, someone passes away, do the roof, fix a leak, gotta fix a car, you gotta do this, you gotta repair that, unexpected expense, holidays, birthdays, you name it, all these different things. So it's very hard to do apples to apples comparisons, especially when it comes to making extra payments, because we also have to factor in, hey, does that person have an emergency fund for unexpected expenses and emergencies? If they do not, then we need to allocate some of the cash flow to savings so that if and when life happens, it doesn't put a halt to our debt payoff timeline. But no matter what, whether you take from cash flow to save money to have 3 to 6 months worth of expenses, that's taking time away from your timeline, right? So what ends up happening is this would actually, if I'm making extra payments and life does happen, it would take me longer to pay off that debt. And then when it's all said and done, 2.5 years, 3 years from now, let's say I do have the property fully paid off. So I recover that mortgage payment of the $3,500 I no longer have, and then I get to just stare at a property that's fully paid off. Just stare at it. And most of Americans have no idea how to leverage to create more income, to create more wealth, because you're being told that debt is extremely bad, and you should avoid debt, and you should pay off all your debt extremely fast, as soon as possible, which is all fine and dandy. But what happens when there's financial crisis, market crashes, real estate crashes, like all of it, crises happen. How do we continue to leverage and be effective and efficient with our money, right? So if we could just learn how debt can be of advantage, of use to us, rather than it taking advantage of us and us being a slave to the lender, how do we become efficient borrowers? And how do we then put ourselves in a position to be a lender? So what's happening is I'm lending from myself, my own banking system, to myself. And then I'm retaining all the capital and the liquidity in the process. That's a huge benefit to really think about whether you just want to make extra payments on your property or do it this way. So let's continue. At the top, 477 total income going into the first lien over a 30-day period. Expenses coming out, $10,747.74. Gave you all the math over there, gave you the enhancers that I'm using over here. Now here's what I would say if someone that, I hate velocity banking, I hate infinite banking. Okay, whatever. You hate it, you don't like it, great. The least you could do is at least enhance this to your debt snowball strategy. Leverage credit cards at 0%, doesn't cost you anything. Earn cashback rewards, get that extra $1,600, and you can apply that towards the principal pay down of your mortgage, and that's going to help you go faster. At least just do that, right? You could, fine, forget about the first lien HELOC, right? Because if obviously, if you went with a traditional mortgage, you wouldn't have a HELOC, right? So let's say you went with a traditional mortgage, the least you could do is leverage credit cards, get cashback rewards, apply those cashback rewards to the statement balance. It's less actual cost of living, which means more cash flow. That cash flow difference goes to the principal pay down of the property. You're going to pay it off faster, right? That alone, $1,600 a year, you probably shave a month or two off. So now you're at 27 months, let's just say, over a 2-year period. That's pretty valuable because you're trying to go as quickly as possible, right? But if you're over here in this camp, you're thinking, what's the most efficient use of every dollar, and how do I retain every dollar that I'm sending to the banks? And that's where infinite banking concept would come into play. Or again, whatever you want to call it. Money multiplier, cash flow banking, cash flow hacking, dynamic banking, all these marketing terms. It's just whole life insurance, cash value life insurance, that you save money in your own banking system, of which you earn uninterrupted guaranteed compound interest tax-free, and you retain liquidity, and you get a death benefit in case anything happens to you. It covers your human life value and covers all your debts. So even though I'm putting myself and my family into almost $500,000 of debt, if anything happens to me, millions of dollars get paid out to my family. Pay off the debt, and they have cash flow, and they can buy more property, they can buy a business and create more cash flow. Do it again and again and again. So some additional information in regards to velocity and infinite banking, these concepts coming together. 3 income streams. I'll share with you at the bottom here. I'm currently funding 4 policies. 2 on myself, 1 on fiance, 1 on mom. So I got $70,000 a year going into mine, $15,000 a year going into mine, $15,000 a year going to my fiance, $10,000 a year going into mom's policy. So total altogether, we got $110,000 per year going into cash value life insurance. So that's coming from the cash flow here of the $14,200. So $14,238 75 times 12 is $170,000. Minus 110, there's really $60,865 left. So technically what would be happening here is really only $60,865 is what retains and remains in the first lien. So as I'm paying this first lien HELOC down, what's going to be happening is I'm also going to be using that same money that I used to acquire the first lien, and then all the income streams going in, and then all that cash flow staying in that paid the property down, I'm going to pull from it throughout the year, 4 times a year on the anniversary dates of these 4 policies, which would send $110,000 into my own banking system. So as of right now, with just 1 policy, not including any of the other 3, just 1 of my policies I have available to borrow. There's more than this number. Available that I have to borrow is $346,456.13. I'm borrowing 10% from the policy to put a down payment on the property. So 10% down, boom. I could throw another 10% if I want, or not, keep it, and then I'm borrowing another, say, $10,000, $12,000 or less for closing costs. So anywhere between as high as $120,000 borrowed, estimated at a 5.6% interest rate, of which I would be getting a crediting rate of 6% on the borrowed dollars. The unborrowed dollars would continue to earn whatever the gross dividend rate is for that life insurance company, which is around 5.75 or 5.85%. If I'm not mistaken, as of 2023, and that's with Guardian Life Insurance Company. Notice how I saved money prior, right? Multiple years I've been saving money from my cash flow. Then I leveraged savings without losing my saving. If I didn't have this and I just had cash over here to make a down payment, it's a one-time use. I never see that money again. The only way I can see that money again is if I borrow. And I'm taught not to borrow over here, taught not to leverage over here. So that never is even the thought process that flows through that person's mind. Whereas over here, I have savings that I built up over the last 5 years. I borrow against that cash value, of which the cash value dollar amount does not actually decrease. It stays the same, and I keep earning an uninterrupted compounded guaranteed rate of return on that money tax-free. What does get reduced is my death benefit. So my death benefit gets reduced by cash values uninterrupted, and that's going to keep growing. Second use. So 1 use, savings. I got a death benefit, protects my human life value. I have access to the savings whenever I want. I set the terms in terms of how I want to borrow and when I want to pay it back. I set all that. Second use, I acquire this first lien HELOC, pays down. I start doing velocity banking because I know that I can effectively reduce whatever the interest rate the bank gives me. I can reduce that at a faster rate than if I was to make extra payments, which would reduce that 8%. Out the gate, they're at 8%. Out the gate, I'm at 4.99, only for 6 months. Might go to 8.41%. In the equation here, that's what I factored at 8.41%. I'm willing to bet and gamble here that my rate will go down. And guess what? If it doesn't go down, I can always switch banks. Go get another intro rate. Switch that HELOC. Go to a different bank. You don't think that other bank wants my business, right? So I go to them, get me a 1.99 or 2.9 or 3.9 or 4.95, whatever it is, as long as it's less than 8. And I retain at a lesser borrowing cost each and every month, right? Powerful stuff. So that's second use of dollars. First use, savings. Borrowed, acquired the first lien. Now I have an asset, property, right? Now I'm paying it down with my income and my cash flow. Same dollars that are being used to pay this down. I'm gonna take money out because it's revolving. I can put money in, I can take money out. I can put money in, I can take money out. So it's revolving. So I take money out and I fund my bank again with the credit line that the bank institution gave me. So I'm using their money, technically, to fund my bank, which would increase the cash value of not just one policy, but all 4 policies. And I can borrow money again and do what with it? Go get another property, let's say, or invest in my business. That creates more cash flow, more income, which I could then what? Dump it in the first lien HELOC to what? Reduce the interest costs of borrowing. And guess what? The whole time I remain liquid. So if you follow this through, these numbers show the ending balances of 1 month, right? So starting at the top, boom, income in, expenses out, bam, balance ends right there. That's your borrowing costs. You minus the 135.27 and you minus the $20. You should be around here, 1,738.82. Ending balance, right? Add them up, 461,378.53. So 461,378.53 after 1 month. Let's look what extra payment did for us. Ending balance, 462,208.57, and you paid $3,180 in interest as opposed to my $1,738. So out the gate, I'm ahead, and I'm gonna stay ahead, right? From that standpoint. But again, extra payments will pay this property off faster than me because they're not taking from the equity of the property to go do something with it. I am, right? So technically, even though I'm going faster out the gate, eventually extra payments would technically pay this off faster than me because I'm not intending to actually fully pay this off completely. I'm trying to get the balance down far enough and fast enough within the first 6 months, all right? Bring it down. It's going to change. It's going to jump, right? From 4.9, it's going to jump to probably 7 or 8%, 8.5%. And with this, because it's based off the 6-month treasury bill, my rate is only going to change every 6 months. So I'll have a fixed rate every 6 months, right? So let's say the second round of 6 months, I'm at 8.41%. So my interest cost is going to, jump, right? Still gonna do the concept, still gonna do everything the same. Go 6 months, let's say rates go down. I get to ride that rate down, right? So next 6 months, maybe it goes to 7.9, right? 7.8, whatever it is, I'm still technically ahead of them. And I'm doing more things with the money. I'm getting multiple uses with the money. But again, I want you to decide what makes most sense for you. Throw everything at your mortgage and try to pay it off as quickly as possible and then invest. And hope and pray life doesn't happen, nothing happens to you, everything stays the same. And if something does happen, guess what? You're gonna be forced in a position to borrow money if you don't have an emergency fund, right? Or 3 to 6 months worth of expenses, or if you lose your job or something goes wrong, you're gonna wanna take the time to also have funds set aside, money set aside. Whereas over here, I don't have to take that time because whatever I'm applying in cash flow, it's available, it's liquid, it's right then and there for me to use. Right? So come over here, right? 1 month, boom, 2 months, income goes in, expenses out, 444, right? Ending balance, 445,692.99. Over there in the second month, they're at 447, 429, 943. They're at 430, 432, right? And the gap will continue to widen. So after 6 months, I get the balance from 477. This is overestimated, guys. Like I project that I'll probably have it at like say around 375, maybe a little less. So 382, 304.82 after 6 months. I mentioned about using this balance transfer of 25K. I was conservative and I said I did it at the 6th month. In reality, I'm gonna do it in the 1st month. At the top of the month, I'm gonna start out the gate, right? Bringing that balance down because it makes sense to do that. Ride the 4.99 as hard as possible. Move some of that debt into 0% location, whatever you can. So I'm doing it at the top technically, but I'm showing me doing it at the end of 6 months. So that's where you see the big imbalance. So it goes to 357, 304.82, income in, expenses out. Notice how the expenses are now higher, 10,997.74. That's because I'm factoring that 250 payment. 340,000, right? Keep going. Ending balance. See, now look, 22, 10, 23 in borrowing costs. as opposed to 1415.85 despite being at a lower balance. And that's because I'm going off of an interest rate over the next 6 months at 8.41%. So that will be a jump. 342, 327. Now, my intent, once I get the balance right around 300,000-ish, right? This assumes I put 10% toward the mortgage, just 10%. If I did another 10% from my cash value, right? So another 53,000, so 327, 401.73 minus 53,000 be somewhere around 274 owed if I pull another 10% from the cash value. So if I did this and said 120,000 borrowed from the cash value, times that by a 5.6% interest rate, the interest cost in the policy itself, I would have to pay, say, $6,720. Now, of the borrowed amount, 120,000 times a crediting rate of 6% is going to be 7,200, the borrowed money only. Then the total actual, this is how much I have available to borrow. The actual total cash value is $358,960.73 times that, or I should say minus 120,000 because I'm already factoring in the crediting rate on the borrowed funds, so 358,960.73 minus 120, and I'm approaching my 6th year with this particular policy. So I'm gonna times that by an internal net rate of return after expenses. We'll go low, 1%. Probably more, it's probably like 1.5 or maybe 2. So 1% is $2,389.60 growth on top of the 72. I should generate this in the policy, somewhere around that number. $9,589.60 earned, $6,720. So there's a $2,869.60 offset positive arbitrage. I offset the $6,720 borrowing costs, made $9,589. You minus, it's a gain of $2,869.60. So what that tells me is it would probably be in my best interest to take another 10%, throw it in the first lien because that rate's going to jump more than likely, and I'm basically borrowing at no cost. There's a cost, but then I offset the cost in the policy itself, and it grows. So I threw the money in there in the first lien. So instead of owing 327,401.73 minus another 53K, say I'm either going to be here 327, or I'm going to be somewhere around here, right? Somewhere around there. And mind you, the line of credit, the credit limit is 477,000. So how much space do I have? 477,000 minus 274, roughly $200,000 of space. As I get into the next year, as I get into 2024, 110,000 will come out one by one, right? All of these policies are due towards the end of 2024. The earliest one is June. The rest are August, September, November, right? So it's towards the end of the year. It's after the rate would have already jumped, okay? So we got $200,000 of equity space available in the line, which is going to be continued to use to max fund my own banking system. What I paid to borrow and pay down the property, I retained and earned more within the policy itself. Then throughout that same time period, within a year, I paid the line of credit, the first lien HELOC, I paid down all the way down to 327, 274 range. And then I took 110 back out. So 274, 401.73 plus 110. Now I'm back up to 384,000 owed. Policy max funded. The internal rate of return is going to grow even more because these policies get better and better and better. The longer you fund them, the better they perform. The more you max fund them, the better they perform. The faster you fund them, the better they perform. So we got a lot going on here. Hopefully I didn't lose you, but this is more of an advanced session here. So those of you that know, you get it. For those of you that are brand new, I recommend taking the time to look at some of my older case studies or going through the playlist where I've got line of credit, HELOC case studies, credit card case studies, HELOC, first lien HELOC case studies, second lien HELOC case studies. Then I got cash value life insurance case studies. And then I have combinations, right? Case studies, bringing them all together. So these are all, really cool way of looking at your personal finances where it's like, I could care less about paying this off. I'm more concerned about liquidity, cash flow, effective and efficient use of every dollar, and getting my banking system fully financed, fully self-funded. I need to get it bigger, right? Because technically I could borrow what? $346,456.13, throw it on the first lien, could do that, do velocity banking, get that paid, and then turn around, borrow against it, fund the bank, keep the loan outstanding for as long as I want, but I don't know if I want to do that. But that would be an option too, right? I would have to run the math, see if that would make sense. I think in theory, it would, because the crediting rate is higher than my borrowing rate, and I'm at the point in time where I can actually create positive arbitrage because I've owned the policy for more than 5 years, going on 6 years, and I fully max funded it each and every year, close to that, MEC limit. So there's a lot of, positive gain there. And let's see, I don't know if I have anything else to add to this other than I showed you the options, right? Both of them get results, right? You go this route, 2.5 years, 3 years at most to get rid of your mortgage. That's pretty freaking fast, but it's a matter of working with your family as a team, right? Combining incomes to target the mortgage. And if you want to enhance that snowball, you can enhance it with credit cards and 0% balance transfers. Doesn't cost you anything, and it'll speed up the timeline. And then once it's all said and done, you can look at your home, at how pretty it is debt-free. It looks the same when it was in debt, but you get to look at it, it's real pretty and it's debt-free, and you probably have no idea what to do with the funds because you were taught not to borrow. But hey, you now have your 17+ thousand in cash flow as a whole family, 3 incomes. You take that cash flow and you go invest it, right? Because that's what you're taught to do next. Go invest in mutual funds where you're gonna, I don't know, somehow earn 12% like Dave Ramsey says. So maybe, right? Can't rely on that, but hey, good luck. Right? Be the millionaire next door. You might say, you know what? I want to do things differently. I want to retain access to liquidity. I want to recapture every single dollar that I spend in interest to the banks. I want to build my own banking system. I want to be able to self-fund everything that I do. I want to be able to borrow and set the terms, right? I don't want to be obligated to loans and terms and different things like that. I want to have access to debt and access to capital to be able to leverage, right? Because we're not even talking about really leveraging the debt to actually go and make a higher rate of return than what I'm paying in interest. And for those of you who are doing this, right, where you're leveraging your HELOC, your credit card, your home equity line of credit at whatever interest rate it is, to then earn triple that in cash flow, and then the cash flow pays back the line of credit, which then reduces your net borrowing costs because you can manipulate it easier, and then you attach velocity banking to it, you're gonna go even faster. And that's it. Right? If you would like to work with me one-to-one, you want to map out your numbers on the whiteboard, I've got plenty of time to do that. I enjoy it. This is me doing an accountability on myself with my own numbers, my thought process, getting it on the table here, sending it to you, getting your feedback, your comments. Hey, you missed this. Hey, you missed that. I think you made a mistake here. And I'm gonna go back, refine it, look at it again and say, okay, yeah. But just understand, I've completely threw velocity banking under the bus. If you really think about it, like totally overestimated the cost of borrowing each month. There's factors that I didn't include to make me go faster, right? Compared to extra payments here. And I do that on purpose so that I can say, at worst, I should do this. At best, I should be way over here. And there might be so many other opportunities or ideas that might present itself, like a business opportunity, a business venture, a real estate deal, whatever the case may be, and I have the liquidity. I never lost a single dollar in savings. If you really think about it, I never lost it. I can access it at any point in time. Whatever I pay in interest, I'm creating an offset by building my business, making good investments, saving money, tax-free, guaranteed, compounded, uninterrupted. So if you'd like to do this with your family, you want to be able to combine incomes, be a team, I think you can actually exponentially increase your results timeline when you work with husband, wife, and kids, brothers, sisters, right? You guys come together and say, listen, I want everybody in this household to become millionaires. If we combine all our incomes and our expenses, and we work as a team, and we leverage each other's credit, and we leverage as much as we can to exponentially increase, stay disciplined, be good stewards, surround yourself with accountability partners. Think of me as like an accountability partner, someone that you can invest in, receive coaching. I have options, right? Where you can work with me one-to-one. You invest in me, I invest in you. We run the numbers, we make it happen. My name is Denzel Rodriguez, your personal finance geek of the 21st century. Have a wonderful day. God bless, and we'll be talking soon.